Okay, hi everyone. This is going to be the second lecture for chapter 16. So I believe we ended here with capital losses. So we're going to pick it up with NOLs. What's going on here? So first off, when we talk about an NOL, that means a net operating loss. And that's just a fancy way of saying, hey, you had more expenses than you did revenue. You're, in the negative there. So essentially, how does this work, right? Because in the bigger picture, we're talking about book to tax differences. This must in some way then be a certain way you do it on the tax return versus a certain way you do it on the books. Well, generally for books, right, you're going to report an NOL when it happens. However, for tax, we have kind of a wide variety of complicated rules here. To make a long story short, essentially, it depends what year the NOL arose because there's different rules. What I care about is that you know the current rule, and that says, hey, if you have an NOL right now, for tax, what you do is you carry it forward to the future. And when you carry it forward to the future, you can offset up to 80% of modified taxable income in those years. So don't get bogged down in it any more than that, right? You can look at 16.9, 16.10 if you want to, but let's just keep it simple on there. All right, next thing, charity, right? There's going to be a book to tax difference here for charitable contributions. Starting with book, right? So what do you do for book? Well, generally, right, you're going to have a deduction in the period you pay or accrue it. Once we make that promise, right, to pay the contribution, right, the board says, hey, we're going to pay it. It's kind of a fixed obligation. We would do debit, charity expense, credit, charity payable, sort of traditional accrual accounting. On tax, things can be a little bit different, right? Because we have some things that can depart from that rule. So first off, when we talk about tax, when you're valuing the amount of the charitable contribution, you have to look at what you're giving. So if it's money, it's the amount of money. If you're giving long-term capital gain property, we're going to value it at the fair market value. If you're giving ordinary income property, we're going to value it at your adjusted basis. Okay? Now, the first way a difference arises potentially is a timing difference. So, as a general rule, right, a corporation for tax purposes is going to make and take a deduction for charitable contributions when they make the payment. However, if we have a corporation and they use the accrual tax method, they can deduct the charitable contribution in the year before they pay it if the board approves it and they pay it within 3.5 months of their tax year end. That's a mouthful. Let's look at, what does that say? There's 1611, so let me pull that over. This is essentially a fancy way of saying, okay, here's year one, here's year two, right? If we, right, we're an accrual basis C Corp, if we pay it within 3.5 months, right? So we pay the money over here in that window. Even though we paid it in year two, we're going to get the deduction for year one. Okay. So let's look an example here, right? It looks like in December, our board approved charitable contribution. That's great. For our books, we took the expense. And it looks like, hey, we paid it in March, right? We're in that 3-month window. We get the deduction on tax. That's great. No book to tax difference there. In distinction, if we change the facts, right? If we said, hey, they paid it over here, right? Well, in that case, we would have gotten the deduction on book, but we get nothing on tax, right? So that would give rise to a book to tax difference. All right, so we said kind of the first way it would differ would arise from a timing event. The second way it could differ essentially deals with a limitation. In other words, they cap for corporations how much of a charitable contribution they can get. Specifically, it's going to be 10% of the charitable contribution limit modified taxable income. That was tested, that would be given to you. But essentially, you can think of it something like on the books, they get to deduct the entire amount. On the tax return, we have a cap, a limit, right, that we're allowed to deduct. Sometimes it can be the same, right? You can get the same charitable contribution on both, but it can also be, hey, I get to deduct the entire thing on book, but I only get to deduct part on tax because I got this cap, this limitation. And to the extent you're limited, right, you're going to carry forward to the future 5 years any kind of jammed up charitable contribution. So let's look here at 1612. All right, so they're giving us some info, right? It looks like we have some income, and built into that number are these items. First thing we got to do is get to that charitable contribution modified taxable income. So we make some adjustments. We're going to land at 128. All right. Next thing we do, right? Step 2, we say, hey, we have that limit, right? In other words, 10% of that amount is the max we're allowed to deduct for tax purposes. Okay, so 12/8 our max. But step 3, we gave $18,000. So we gave 18, but our max is 12. That additional 5,200, we're going to carry forward. And by the way, that's probably also going to be a book to tax difference, right? 1613, that's just showing it reversing, how that kind of works. And then you can look there at 1614. All right, so this is just saying, hey, remember, there's a 10% limit on those charitable contributions from corporations. All right, next thing here, the next book to tax difference, the DRD, right? This means the dividends received deduction. What do you do for book? Nothing. This doesn't exist for book, right? So you're never going to get this on book. Accordingly, it's a permanent difference. What do you do for tax? Well, it's some kind of deduction, right? What are we doing here? So let me kind of draw this out to show you. Right, so say that we have a corporation, right, that's great, and then we got a shareholder. And we said, hey, they make $1,000. There's going to be tax 1, where they're going to have to pay 200. It would be 210, but whatever. Let's just keep it simple. The remaining $800, they push out to the shareholder, and they're going to have tax 2, or I don't know, let's just say $80, right? So we got 2 layers of tax here. What if, however, right, we had one corporation, I don't know, let's just name it Corporation 1, that it was owned by another corporation, right? And then that corporation was owned, by an individual. If you think about it, right, if we have that $1,000, at this point, right, it's going to be taxed potentially 3 times by the time it sort of trickles down to the shareholder. So what the IRS does is they say, okay, look, you right here, if you're a corporation that owns another corporation, if they pay you a dividend, right, I don't know, let's just say $800, right, we will give you a deduction for that. And it could either be a deduction for the entire amount or part of it. It really depends how much ownership does this guy own in the first corporation, right? So that's the idea here. How much they own. If it's 20%, they get a 50% deduction. If it's greater than 20 but less than 80, they get a 65. Greater than 80, 100%. So that's the idea there with it, right? So it's a deduction that you get on the tax return. You'd never get it on the book. Who gets it? That kind of sandwich C Corp. Why do they get it? To prevent triple taxation. How much is it? Well, essentially what you're going to do is take the dividend and multiply it by the percentage here. But there are some caveats to that. So let's look at 1615 here. right? So here we go. We have, one corporation that's owned by another corporation, and it looks like they paid them a $30,000 dividend, and this guy owns 1%. Okay, so we're less than 20%, we're at 1%. The deduction is 50%, right? So we got 30, 50%. The deduction is $15,000 for this guy. And down here, you can look at it. It just shows, hey, how by virtue of giving that deduction, are we mitigating that triple taxation, right? So that's just kind of sketching out the idea of the DRD. Let's actually quantify it now in the sense that that deduction, the $15,000, right, that we just looked at, that's at the end of the rainbow, right? That's like, if it's perfect. We are going to subject you to a limitation on the DRD. And essentially what you're going to pick is the lesser of the full DRD or the DRD limit. The full DRD is what we just calculated, right? The $15,000. The amount of dividend times the 50% versus the limit, which says, hey, the modified taxable income, so it's income without regard to these guys, that would be given to you. I'm not going to make you solve for that. Let's just say, hey, it was $10,000 times same percentage from the table, 50%. We're looking at $5,000. So in this case, this is the lower of the two, right? We're going to get capped, right? We don't get to the end of the rainbow. We're going to put a limitation on that DRD. So let's look at 16 here. Right, so they're saying, hey, our modified taxable income is $53,000. There's a $30,000 dividend. In this case, we own 1%. We get a 50%. That's our full DRD. All right, but remember, we said that's at the end of the rainbow. We have to pick the lower of the full DRD or our modified taxable income times the same percentage. So here, right, 15 versus 26.5, 15 smaller, that's what you get. If we change the facts, right, say that our modified taxable income was 28,000, right? Then what we do is we run the same numbers, right? But when we pick the lower of the two, that guy wins, right? We're limited, we're capped. So, that's the idea there with the DRD. It's meant to prevent triple taxation. Generally, how do you calculate it? Well, it's going to be the lower of these two. And hey, we got a deduction here. Maybe it was $5,000 on our tax return. We would get nothing on our books, right? Because this doesn't exist on the books. It's a permanent favorable difference. Now, you can look at this, right? This is kind of like the exception to the exception. This is basically saying there's a situation that arises if you deduct the full DRD and it would put you at a NOL. If you ran the numbers and that happened, then you can deduct the full DRD even if it isn't the smaller of the two. So that's just saying, like, say you picked that guy, right? Like over here, the $5,000. If you ran the numbers, and you can look at this in 1617, if subtracting the full DRD puts you at an NOL, then you can still deduct it. It might not make sense like verbally, but if you look at 17 there, you can see it. But don't get bogged down in this kind of exception to the exception. I'm just more concerned with like the basics, the blocking, the tackling. All right, so the next thing here, it just basically says, be aware that corporations have a flat 21% tax rate. And if you have a giant corporation, right? So there's only 150 of them. They have to have a billion, 1 billion, yes, with a B of adjusted financial statement income. We're going to look to their books, right? Then there is, an AMT in play, and essentially they better at a minimum be paying 15%, right? So here's the 1120, right? Don't be deceived. It's it's a complex form. It's like C Corp returns tend to be a lot harder than individual returns, but we're just doing the basics here. We're showing you the layout of it. One of, and perhaps the most important schedules when you're doing a C Corp return is the M1 in the balance sheet, the Schedule L. And essentially what happens here is you go from your book income to your taxable income, right? So maybe we had $1,000 on book, right? And the way the form works is it kind of snakes like that, right? Maybe we add $100, we subtract 25 books. These are just the book to tax differences, right? All of this stuff in here are these specific book to tax differences that we've just been talking about. So that would land you at your taxable income, right? So that would be what? 1,075, okay? And the next thing, right, is, let's see here. No, that's the M3. Oh, okay, let's talk a little bit about the M3. So the M3 is the same thing. You're going from book to tax, but it's a lot more specific, right? It's kind of like an M1 on steroids. You only have to fill out an M3 if you have more than 10 million in assets, right? In M1, there is like a threshold on it, but it's a lot smaller than that. Normally, if you're working like, let's put it this way, if you're doing like mid-sized clients, right, you're like a regional firm, you're definitely seeing an M1. If you're at a big four firm, you're probably seeing an M3, okay? So, these are just, explaining those items. The next thing here is the Schedule L, right? This is really important. So first off, even though this is on your tax return, it is your book balance sheet, right? So over here, right, if we look at the end, right, this is the book balance sheet, right? This would be like the PBC prepared by client. Essentially how it works when you prepare C Corp returns is you basically put this, what the client gives you, into an Excel doc or some type of spreadsheet that's linked to the tax software. You then make the adjustments, right? The book to tax adjustments, and you arrive at your taxable trial balance, right? In other words, based on the tax amount once we look under the tax rules, okay? So the idea with this is when we're looking at the Schedule L, right, we're looking at that book, right, that prepared by client. And essentially, this is showing prior year and current year. It's beginning of year, yeah, but like last year's ending is this year's beginning. You really don't have to worry about this column in practice because that's going to roll forward from the software. But one of the main things that's like extremely important if you're doing any business tax return, a partnership, an S Corp, a C Corp, is if you give your return like to your senior or something like that, the first thing they're checking, right, is if the balance sheet balances, right? And the idea with this is maybe you have, I don't know, $1,000 here, and you have 950 there, right? And the way the software is like linked up and interrelated, essentially there's like two ways that this could have happened, right, where it doesn't balance. One way is, right, your assets, your liability, and some of your stockholder equity accounts, you screwed up the inputs, right? Maybe you like inverted a number, maybe it didn't import right. So it could just be like sort of like a keystroke error or something. The more likely way it's screwed up, right, comes into, where's it at down here? Um, into your retained earnings, right? And the idea with this is, remember, we're looking at books here. Retained earnings is your beginning plus your net income for the period minus your dividends equals your ending. Now, why do we care about that, right? Well, usually what happens is if this is screwed up, it means our net income is screwed up. So we got to go over here and look at our book net income, right? And see, is that correct? And normally what happens is we forgot to do something in here, right? Because the way the tax software functions is it actually kind of backs into book income. So this is a challenge or like an experience that you'll see at the end of doing a return is, why isn't it balancing? What do I got to do? So sometimes you need to go in and make additional adjustments. Sometimes you need to see, did I enter everything correctly? Again, I'm just giving you the high level overview, some context. It's easy to just show these forms. I'm trying to give you like an insight of like, how do you actually use them or why should you care about them in practice outside of the obvious, like this is the return itself. All right, the next thing here, just be aware that if you have an affiliated group of corporations, they can file a consolidated return. And again, this is at the federal level. There are some benefits from doing this. It's the functional equivalent of, if you remember like your intermediate 1, intermediate 2, where you get like sort of a parent company that owns all the subs, that they would consolidate the books and records. It's kind of a similar thing at the federal level for a tax return. Hey, we have an affiliated group. We can let them file one return instead of a bunch of individual returns. Okay, generally when you're talking about C corps, you're looking at a 4/15 year end with a 10/15 extension date. Do be aware that just like individuals, they have to make estimated payments for their tax liability. If they don't put enough into the system during the year, they could get hit with an underpayment penalty. But how do we avoid that underpayment penalty, right? So that's why we have these safe harbors, right? This is like a safe zone, right? In other words, if during the current year you put enough into the system to meet a safe harbor, you will not get hit with an underpayment penalty. And what are the safe harbors? What are the tests for C corps? Well, essentially, you're going to have 100% of the current year. There's like a variation on that, but that makes sense, right? If you owe 1,000 for the current year and you put 1,000 into the system throughout the year, there's nothing that's underpaid. If, however, right, sometimes that's hard to do. I don't know how much I'm going to make this year, right? So if right now it's a mystery how much I'm going to make, I don't know how much to put in, you can phone a friend to year one, right? And maybe in year one we owed $5,000. What that means is if during year two we at least put $5,000 into the system throughout the year, we won't get hit with an underpayment penalty. We could owe the additional tax insofar that, say we put 5 in, but our liability was 7, right? The 2 there you would owe, you just would not get hit with the underpayment penalty on top of that, right? So you still owe the incremental amount. You owe what you owe. The question just becomes, is it going to be like insult to injury? Like, do you need to add on top of that this underpayment penalty? So you can see how it's calculated here. Don't get like bogged down in the actual calculation on this. Do be aware more of like the standards though. And then, right, you can read that, not a big deal. I want to talk a little bit about here this final area right here. So this is an important thing for you in the sense like somebody somewhere in your accounting education should tell you that the way you see trial balances in your textbook are not how they're presented in real life, right? Because like when I first started, right, in practice, however many, like 10 years ago, whatever, right? I was like, what is going on, right? This is like blowing my mind. It's nothing like what I saw because this is what you're going to see in practice, right? Something like this, a single column. And I'm looking at it the first time and I'm like, wait a minute, revenues are negative. What is going on here, right? So how do we go from what you see in the book to what you're going to see in practice? So first off, get rid of the idea that it's going to be in two columns, right? Start with the fact that it's going to be a single column. And how we make sure that it balances, right? Right here it balances. And it's a little off balance seesaw, but just hang in there with me. It's balancing. How we get the functional equivalent of that is if we have this, right? If we sum this, we do our assets minus our liabilities, we get to zero, right? So that's like the first modification. So we're going from what you see in the book to just be aware it could be consolidated, a single line item. Then to build off that, right, how do we get to this, right? What's going on here? Well, this is essentially a natural balance, trial balance. And what does that mean? Well, essentially, you think about what do you normally naturally debit versus what do you normally naturally credit. So think about financial accounting, right? Got cash for a car, debit cash, right? You're normally, if you increase an asset, you debit the asset. And in this framework, anything that you debit naturally, if it increases it, asset, it has a natural, right? If the plus over here is naturally on the left, it's going to be a positive number, right? So normally debit asset, debit cash, right? Normally debit expense, right? Everything else you credit, right? If you can't like get it, just memorize these two and everything else is the opposite. But if you want to think about it, right? Think about liabilities. Normally you credit the liability, occurred in account payable, right? Credit payable. We earned $5,000 in revenue, credit revenue. We issued stock, credit common stock, credit APIC. So again, if you go into practice, this is how you're going to see it. And how you know that it balances here, right, is if you just do a sum, right? It's not like over here, it's like a modified version. You got to take your assets minus your liabilities minus your stockholders' equity equals zero. Here, it's changing it up a little bit. Instead of doing the subtractions here, we make these negative based on their natural balance. And in this way, we can sum it to zero. So, just be aware of that. When this is whether you're going into audit or tax, this is just like really like I'm trying to help you because when I first started, this took me like a couple weeks. I was like disoriented. I was like, what is going on here? This is crazy. So with that, I'm going to end it here and we'll see you next time.